We had decent earnings this week. The FOMC actually went quite well and Powell actually came across dovish. So why in the world is the market still falling? I believe we have really been too focused on inflation data that we actually missed out what Powell actually told us during the FOMC meeting. And as people start to understand and look at the data the same way that Powell has been looking at the data, then the road ahead may not be as smooth as we thought initially. Now, if we look at the fear and greed index, the sentiments in the market is currently fearful, and I will not be surprised to see this actually shift all the way down to extreme fear in the coming weeks ahead. So let's start by talking about earnings. Now, in terms of revenue and EPS, if you look just across the board, most companies actually did quite well in this current earnings. But only after we listen to some of the earnings call, then we can understand how management is actually looking at the economy in terms of AI and the consumer. So in terms of AI, right, I think we can actually see that across the board, there is still demand for AI. And then I actually realized, right, there are actually two sides of this AI story. The first part of this story includes the training of the AI models, which is where a lot of the companies are right now. And the second part of this AI story is delivering the trained model into the hands of the consumer. Just bear in mind, even as we speak about AI in this video, we're talking about demand from companies and not so much from consumers. So we're actually focusing on companies who are training out the AI model and basically how that will affect their business. Let's dive into some of the earnings calls. Tesla actually had good delivery, right, in the last quarter, but growth was actually quite muted and margins actually contracted because of the cyclicality of the business, because they're also a very interest rate sensitive company. So as interest rate comes down, we hope that their revenue and their margins will continue to expand. However, during the earnings call, Elon Musk actually said something that was quite interesting. They said that they basically couldn't get enough of Nvidia's GPUs, so they had to make Dojo work if they wanted to continue to train their AI. So basically, we can see that there is still huge demand for Nvidia GPUs. Now Google actually did quite well in terms of their top and bottom line numbers. Cloud growth was actually good as well. And as I mentioned right previously, basically Google acknowledged that, you know what, AI really will drive profitability for companies. But they kind of like dodged the question a little bit when asked about how it can be a revenue driver. They basically said that since it can drive profitability, I'm sure it can also, drive revenue. So it wasn't a really convincing answer. And along with the increase of their capex spending, right, I think that's what pushed the stock price down. And basically 2 weeks ago, I think that's what led the market to sell off. And so this week, similarly, Microsoft actually initially dropped about 6% when they had softer than expected numbers on cloud. But after the earnings call, they actually basically addressed some of the issues that people were seeing in their numbers, and the stock actually rebounded a little bit. It was down only 1 to 2% during the day of their earnings. So they had good earnings, and they said that they only bought chips as they saw demand. They didn't buy it in expectation that demand will come. It's only when they have such demand, then they will start buying the chips. So I think from there, we can actually see that the demand is strong because the AI adoption is still ongoing. Companies still are building out their AI infrastructure. And if we combine it with what Google said, it just means that people are using more AI. Businesses and companies are actually using more and more AI, but it may not drive up revenue growth as much as we expect. And both Microsoft and Meta actually said that they have increasing capex spend, which is basically the similar trend as what we see in Tesla and what we see in Google 2 weeks ago. So now consider this with me for a minute, okay? Everyone needs to kind of integrate AI into their offering, right? Google is putting it into the Pixel, Apple is integrating it into their iPhone. So the amount of capital expenditure incurred by these companies will be high, and they already told us so moving forward. And the question remains, right, whether or not the results from the investment in AI justify their high capex spending, because this would definitely affect their free cash flow. And we know that when Wall Street looks at this number, if the free cash flow is decreasing year over year and not having any material impact on the top and bottom line, that is something that basically the stocks will be punished for. Because to me, there could be very easily a scenario where the AI adoption actually drives up profitability, but there's a limit to how much margin can expand without a significant increase in revenue and increase in the economies of scale. So companies might be forced to let some people go to balance the books. So if you take a look with me at some of these numbers that were just reported in the Business Times, right? Amazon actually cut jobs. They cut actually about 5% of their employees at the Buy with Prime unit, 5% in Audible. And the biggest cut we actually see is in their streaming platform with Twitch, among several other divisions. Google as well, although during the earnings call, they actually said they're hiring new graduates, but in general, they're actually also laying off dozens of people in different divisions across their company. And the layoffs in Google basically include a lot of the hardware team responsible for Pixel and things like that, and the majority in the augmented reality team. Okay, Microsoft is cutting jobs at their games division, Activision, Blizzard, and Xbox. And I think the most significant one is actually Intel. Intel actually said that they will cut 15% of its workforce, right? That's about over 17,000 people losing their jobs immediately. eBay cutting about 10% of their workforce. Unity Software, basically their video game software provider, they're cutting about 25% of their workforce, about 1,800 people. And at the same time, Snapchat actually plans to lay off about 10% of their global workforce. Now, all of this is happening at the same time that I feel like a lot of companies are actually slightly overvalued or priced for perfection. They may not be significantly overvalued, but basically if any small issue appears in their earnings call, they miss certain numbers, they will get punished, which is basically what we saw in for many companies this week. So turning our attention from AI into the consumer. Amazon actually had decent earnings, but actually they showed some weakness in the consumer in terms of their buying power and things like that, especially the slowing down in growth in online sales. So they basically forecasted it into their Q3 results, which actually caused their stock to tank. So you can actually look at it, right, when they were talking about it during their earnings call. Basically, the trends that they are talking about, they actually see that consumers are being more careful with their spending, trading down and looking for lower ASP products, means average selling price, looking for deals lah. So basically that continued into Q2, right? And we expect it to continue into Q3. So basically, Amazon is telling us, hey, the consumer is actually looking for more better value deals, and they are not just spending as much as they were in the last couple of years. Now, a couple of weeks ago, I was also saying that we have to pay attention to Visa's earnings, and it was quite surprising that they actually had a miss in their revenue. And during their earnings call, they actually said this. In the US, while growth in the high-spend consumer segment remained stable compared to prior quarters, we saw a slight moderation in the lower spend consumer segment. And what this tells us is actually like, hey, people are actually cutting down on their spending going forward. And if you put these things together, people are basically unsure about the value that AI is going to bring to companies after hearing what people say, but yet at the same time, companies are aggressively building out their AI models and their AI training capabilities. But what kind of impact that will have on their top and bottom line remains to be seen. You combine that with the fact some companies are actually starting to lay off people just to cut costs, and at the same time with a weaker consumer moving into the quarters ahead, then you can see why markets are naturally nervous about what's to come. And so your question is, if all these things that you said are true, then why didn't the market sell off earlier? Why was there a bounce up in the middle of the week? Why did all this only happen after the FOMC meeting? What exactly happened and what did Powell say? So for that, we want to look at the Q&A in the FOMC and look at how Powell answered some of the questions to basically gain an understanding of how he's looking at the market data and how he's looking at the economy. Now, when we talk about the FOMC, I basically want to look at 4 different questions grouped into 2 categories. The first 2 questions addresses the possibility of a September rate cut and what is going to affect that decision. The second 2 questions basically will affect how Powell actually looks at the economy and the data that are coming in. So the first 2 questions, right, basically the first one is, why don't we cut now? Why wait until September? And the second question is, if things remain the same, is September cut a baseline? It means that, if the economy and everything stays constant, does it mean that September confirm will cut? Okay, so basically to this question, right, Powell actually said that they are going to be data dependent, not data point dependent, and he was very specific on this. He's saying that not any one data point are going to affect their decision, but the data as a whole. So Powell actually tells us, right, that the economy is moving in a direction where it warrants reducing rates. And so basically by saying this, right, they're giving themselves a little bit of a leeway in case there are 1 or 2 data points in August coming in hotter than expected. They are still able to cut rates and reduce rates in September without going back on their word. Powell actually tells us that the Federal Reserve wants to take a broader view of the economy and inflation moving forward. And I think this line, a broader view of inflation and the economy, is very important. Please remember it. Later on, I'll address it in the video. So previously, because of how bad inflation was, they were mainly focused on driving down inflation, and now they basically want to have a broader view of both inflation and the economy lah. So what kind of data will they be looking at? He actually said that they'll look at inflation data, employment data, economic data before deciding in September. However, of course, if things remain as they are now, then likely we can expect them to cut lah. Basically, he has all but promised us a September cut as long as things remain the way that they are without actually saying it. And when he actually talked about the consensus of the committee, most people are in consensus. Actually, everybody seems to be in consensus for a September cut. There are some people actually urging for a cut this month lah. But actually, we can see that they are moving in that direction already. The third question to me is actually quite a good question, because the person asked, the Federal Reserve has always said that they are not going to wait for inflation to reach 2% before starting to reduce rates. Does that also apply for the labor market, which means that they do not want to see unemployment start to go up before they actually reduce rates to control the level of unemployment here? Because higher rates, right, generally put more pressure on companies, and then they hire less, they tend to let go more people in order to continue to operate with a more streamlined cost structure lah. So they're basically saying, are you going to wait for something to happen in the labor market before you start to reduce rates, or are you just going to act preemptively like what you were doing for inflation lah? How is this basically related to what I said earlier, right, about the Federal Reserve having a broader view of the economy and inflation? You see, Powell actually basically told us, right, we have 2 mandates: maximum employment, stable prices. In the past, we are only focused on stable prices because inflation was so bad. It means that when they look at data, they were actually only concerned about the data that actually showed that inflation was easing. And so as long as data comes in to show that inflation was easing, they're okay for a period of time to forego maximum employment. So although we see unemployment actually start to climb up from a mid 3% range to 4% to now 4.1%, the Federal Reserve still kept rates where they are today. However, Powell is basically telling us that moving forward, that is no longer going to be the case. They're going to look at both sets of data equally. And basically the fourth question about cutting rates is that whether or not cutting rates is going to be a one-time thing in September, it's just going to happen one time, or is this going to be a process towards the normalization of rates? And his answer to that is basically telling people, look, we look at the economy as a whole, both inflation and employment at the same time. He said that the US are in a moment where they are actually having lowering inflation, at the same time having pretty strong labor market. And they want the rate environment to basically support this strong economy. And so what he's actually saying that it's not about a one-time cut or a process. Basically, he's saying that they're going to adjust policies such that they want the economy to maintain the way it is now, lowering inflation while at the same time having a strong labor market. And basically, when answering this question, he actually said, we don't need to be 100% focused on inflation because of the progress we have made. He actually tells us that high prices and high unemployment negatively affects people's life. And previously, because of the situation with high prices, which is inflation is so bad that they had to focus on that. Now they no longer have to do that. This line that he said was actually very important. He says that although if you compare the two now in terms of their ideal scenario, which means maximum employment and stable prices, he actually says that inflation may still seem like it is further from the goal than unemployment. But with recent data, there seems to be less risk of inflation coming back compared to a risk of real slowdown in the economy. Hence, we will look to adjust the rate such that our policy is no longer as restrictive to support the labor market. Tying all this together, right, there was a period of time where basically good news was bad news and bad news is good news. Basically, what happens is when labor market data comes in, they actually show that the labor market is strong, the jobs market is strong. Instead of being happy for people having jobs, actually people became concerned because the Federal Reserves are going to keep interest rates high, which is basically restrictive for the economy. So basically, when good news came in about economy, it was basically perceived as bad news. However, when bad news come in, wow, people are getting unemployed and things like that, it was taken as good news because they think, hey, people are being unemployed means the Federal Reserve likely to cut rates and then actually make it a better economy for us moving forward. Now, with the change of stance of the Federal Reserve, I do believe that people have to look at data and take it for face value, where good news is good news once again and bad news is bad news. So which is why when we look at all these company data, when they're actually laying off people, when they're saying that, hey, you know what, we are not too sure whether or not we can drive up revenue, profit, yes, revenue not so much, things like that, people start to get worried. When we look at the July jobs report, we can see that the US created only 114,000 jobs in July, basically a slowdown in hiring pace, and at the same time, unemployment expectations were basically 4.1%, but it actually ticked up by 0.2% to 4.3%. And the average hourly pay is actually on the downtrend. Now it's basically growing at about 3.6% only. So lesser and lesser people are getting hired, people are getting pay raises, but not as much as they were previously. And because of all this, like I said earlier, people are now looking at the data for what it is, right? In the past, this may have been considered a good report, okay, because this is actually not inflationary. However, now when Powell says, hey, our attention is equally weighted on both jobs and inflation at the same time, this now becomes a bad report and people are starting to be afraid of a possible recession looming around the corner. And so that is basically why you can see actually a lot of the stocks that we are holding actually sold off in the last couple of days. And so moving forward, we need to think about how we can position our portfolio in the case that there is a recession coming up. And if we actually move past this couple of months without a recession or with a very mild recession and we reach the election, I believe that after the election, the stock market will start to do well again, as it usually does post-election. And with that, I'll see you in the next one.